Hey, everybody, welcome to another episode of Money and Stuff. Today, we're going to be talking about the three things you can do before the end of the year to help you on your taxes. Like I said, this is Money and Stuff. We talk about your personal finances, we cut through the noise, and tell you exactly what you need to know. I'm your host, Sam Rodriguez, certified financial planner. With me, as always, is Conor Shepard. Conor, how's it going today, man?
It's going good, Sam. With us being close to the end of the year, I know this is something that a lot of clients have been asking us about and, wanting to know some solutions to help improve their tax situation. So I'm excited to get
Yeah,
into it.
let's just jump right in. So, number one is looking at your pre-tax 401k contributions. Now, what this does is it reduces something called your adjusted gross income. Your adjusted gross income is basically whatever you're paid minus your deductions to come up with what the IRS is going to actually tax you on. Now, anything that you put in pre-tax into your 401k gets taken away from that adjusted gross income. So that way it's not counted as income. And so you're not taxed on it for the year.
The 2023 contribution limit for the 401k is 22,500 for the standard contribution. And then if you are 50 or older, the catch-up contribution is up to 30,000.
Yeah, so if you're 50 or older, you get a $7,500 catch-up contribution that you can contribute to your 401k. So that's a total of $30,000 that you can get taken off of your income. When you put your money into this 401k, it saves you the percentage of whatever the highest tax bracket that you're in right now. So for example, let's say you're in the 24% tax bracket and you put an extra $1,000 into your 401k. Well, that 1,000 times 24% is $240. So that $1,000 is going to save you $240 in taxes. So take a look at your 401k and see if you have any room to contribute more. So one thing to consider is as we're coming up to the year end, a lot of people are receiving year-end bonuses. What you can do with that year-end bonus is you can go in and adjust what your percentages that you're putting into your 401k and have them take a lot more out of your bonus than what would normally come out of your paycheck. So that way you don't feel it in your budget for the month. Number two is bunching your donations and your deductions. In 2017, the tax law changed. One of the major things that changed in there is what the standard deduction is. So before 2017, the standard deduction was $6,300 for a single filer and $12,600 for a married filing jointly filer. Now those have jumped up to $13,850 and $27,700 for married filing jointly. So what that's done is created a situation where it doesn't really make sense for a lot of people to itemize. As a matter of fact, before 2017, about 30% of filers itemized on their taxes, where now less than 10% of people itemize because it's hard to cross those high thresholds. One of the downsides to that is that when you make your charitable contributions, if you're taking the standard deduction, your charitable contribution is not actually benefiting you from a tax perspective.
Does that mean that people who are making charitable donations and contributions aren't receiving deductions for those donations?
Yeah, that's right. A lot of people don't realize that if they're taking the standard deduction, they're not actually getting any sort of tax benefit when they're making a charitable contribution, like to a local organization or to their church. That doesn't really matter to the organization, but they're not getting the deduction anymore. Because in order to get that charitable donation deduction, you have to itemize on your taxes. And it only makes sense to itemize on your taxes if you have enough itemized deductions that are more than the standard deduction. And for a married couple, that means you've got to get almost over $28,000 in deductions before you start seeing a benefit. So one of the things you can think about doing is bunching your donation. So what does that mean? Well, let's say that this year you were going to give, let's say that this year you were going to give $5,000 to a charitable organization, and you were going to do the same thing next year as well. Well, that's $5,000 in each year, right? It's pretty far below that standard deduction. But what if you decided, hey, in December, I'm going to go ahead and give this year's contribution of $5,000 and next year's contribution of $5,000. So that way for the year, you have a total charitable contribution of $10,000. And what that does is puts you a lot closer to overcoming that standard deduction. What that does mean is you'll probably end up alternating how you take your deduction from year to year. The years that you bunch all of your charitable donations, it may make sense to itemize that year. But then the following year, because you're not making your charitable donations that year, you're probably going to take the standard deduction. And then the following year, you'll bunch your donations again. So it does take some planning and it does take some remembering which year you did what. But bunching your donations can help you get much closer to crossing that threshold. Number three is contributing to a pre-tax or traditional IRA and an HSA or health savings account. And the great news about these two accounts is you actually have until April, when the tax filing deadline is, to contribute for this year. So with a traditional IRA, you can put up to $6,500 in. And if you're 50 or older, you can put an additional $1,000 for a total of $7,500.
Are there any income limits or income limitations on contributing to an IRA?
Yeah, actually, it's a little bit tricky. So there's no income limit to be able to contribute to an IRA, but there are income limits as to whether or not that contribution is tax deductible. So there's a few things you want to make sure of. Mm-hmm. First is you want to figure out if you have any sort of retirement plan like a 401k at work. If you do, then in order to get the full deduction, you have to have an adjusted gross income of less than $73,000 or $116,000 if you're married. If you don't have a plan at work, it's a little bit more complicated. If you're single and you don't have a plan at work, doesn't matter how much you make, you can deduct your full IRA contribution. If you're married and your spouse also does not have a plan, there's also no income limit. But if you're married and your spouse does have a retirement plan at work, then your AGI needs to be less than $218,000 combined in order for you to take the full deduction. Now, the second thing you can do is contribute to an HSA or a health savings account. If you're single, you can put as much as $3,850. If you're married or have a family, you can put as much as $7,750 as a total family contribution.
The great thing about the HSA is the contributions are tax deductible, and not only is the growth tax-free, but you can also withdraw from the account. And as long as it's for qualified expenses, it's tax-free on the withdrawal.
Yeah, that's right. HSAs are fantastic from a tax perspective because they have triple tax advantage. Tax-free going in, tax-free growth, tax-free when it comes out as long as it's for qualified medical expenses. And the other really good thing about an HSA is if you don't use it, it keeps rolling over. You get to keep that money. It keeps rolling over year to year to year to year. So let's say that you never use your HSA while you're working. Well, when you get into retirement, there's an extremely high likelihood you're going to be older than you are today, right? And the older that you are, the more likely it's going to be that you have medical needs. And so this can be an account where you actually pay for those medical needs in retirement. And as you're paying for them, it's tax-free as you're taking this money out. So it can be a fantastic place to actually put money away for the medical needs you're going to have in retirement. The other great thing is there's no income limit to it. Doesn't matter how much money you make, you can contribute to an HSA. There is one caveat though. You do have to have a health insurance plan that is a high deductible plan that does allow you to make HSA contributions. So you want to check that out before you try to set one up.
As you get older, the odds of running into medical costs just kind of increases incrementally with your age. But if you have an HSA, then like throughout your lifetime, as long as you continue to contribute to that HSA, it's no secret that the healthcare system in our country is not ideal, we'll say. And having an HSA really can just act as, a medical emergency fund for you. And whether you end up using it now, 5 years from now, or you're just contributing to it for the tax benefit, at any point that you run into medical costs, you basically have this pot of money set aside.
Yeah, that's right. It's a fantastic place to put money, right? It's not what most people would consider a traditional retirement account, but the fact is you're likely to have medical expenses when you're in retirement, and having a place where you can pull money out tax-free that you also got a tax benefit today for is fantastic. All right, that's it. That's 3 things you can do before the end of the year to help yourself out on your taxes. Number 1, take a look at your 401k and see if there's anything left that you can contribute. Number 2 is bunch your donations up. And number 3, look at an HSA and a traditional IRA. All right, guys, if you have any questions, as always, feel free to send them to Conor, cshepard at foundationwealthpartners.com. We'll talk about anything that you want to. Until next time, guys, thanks a lot.